Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics, and excited to have a special show today because we did have first quarter earnings out from Fortuna Silver earlier this week, and certainly has been nice to do these calls the past couple months, especially since Seguela has come online and add on a rising gold price. And it's been quite a pleasure to see Fortuna doing well with everything that's been going on. So I am joined once again by Jorge Ganoza, the president and CEO of Fortuna Silver, as well as Adrian Day of Adrian Day Asset Management. So, gentlemen, it's great to have both of you here and excited to dig in. And perhaps, Jorge, we could start with just an overview of the first quarter numbers and how you're feeling about that and what you guys came back with.
We had another solid quarter, Chris. Again, thank you for the opportunity to be in the program here with Adrian and speak to your audience. As I said, we had a strong quarter. In terms of production, we delivered 112,000 ounces of gold, which is softer than what we delivered in the previous two quarters, but well aligned with our plans, right? In the third and fourth quarters of 2023, we reported consecutive record production at 112,000 ounces in Q1 2024. We're well aligned with our plans. In terms of costs, our AC came at under $1,500, no, $1,495, and our cash cost per ounce was also, under $900 per ounce. So, operationally, the business performed well, and it reflected on our financial numbers. Of course, we reported 9 cents per share on net income. We ran the business with an EBITDA margin of 42% in the quarter. We were able to generate free cash flow, not at the rate we had been generating free cash flow in the previous quarters, because we had several adjustments in working capital, changes in the business performed really well. Production in line, costs tracking well and coming down. We sold gold at an average price of $2,087 compared to $1,990 in the fourth quarter of last year. So we're capturing the benefits of the higher prices, and we look with anticipation to this second quarter, where we're seeing gold trading strong above $2,300, right? So the business is doing well. Mines are performing. All mines delivered according to budget. So yeah, very, very strong quarter from our perspective.
Yeah, well, it was exciting to see, and obviously something you touched in there, that the production number is lower in the first quarter relative to the fourth quarter, which was in line with the mine plan. Perhaps you could just touch on that a little bit, and anything that I know you said you're still on track for guidance, but anything about the mine plan that would be relevant or that you can point out throughout the rest of the year that people can be aware of.
Yes, we have opportunities in the portfolio and some challenges as well. On the side of opportunities, I would point out to our Seguela mine, where we continue to test the boundaries of design capacity, right? So we are currently doing 42% better than nameplate capacity in terms of mill throughput. And with respect to what we budgeted for 2024, in terms of throughput, we are in a position to do 25% better than that, right? Run the mill at 220 metric tons per hour. So that's a big opportunity. We have challenges as well, as we noted in our news release and our MD&A. In the Ivory Coast, there are some power outages. We right now do not see an impact on our production, but something we're watching closely. Yeah, that's an emerging risk, but so far we don't see an impact to our production, right?
And I think, Jorge, you said you were getting your own generator for the mill, for the mine.
Yes, when we did our assessment, Adrian, for the Seguela construction, or assessment told us that in CDI, in the Ivory Coast, we have ample power generation capacity, and the distribution lines are generally stable. And of course, now we had a freak accident where 3 power generation lines have come out of the grid at the same time.
Sounds like
so we have said, it's a freak accident. All of the 2 power plants with independent issues happening at the same time. What are the odds of that? So we decided to go ahead, and instead of just having backup power for critical processes, to move ahead and bring on site genset capacity to be autonomous. That's going from about 1.5 megas of installed power on site to about 9 to 10. We're already moving in that direction, and we should have the power available for self-generation on site by July. Now, in spite of this freak accident, we still view the generation capacity and grid in Côte d'Ivoire stable, and the problem is improving. Currently, one of the power generations came online. We're still seeing some power interruptions, but again, we right now don't see something that would deviate us from guidance. But still, we want to bring the full backup by July. Yeah.
Okay, and
Seguela
Jorge,
is an important mine that will be producing for gold, in our view, for over a decade, right? So, we'll always be better with that backup on site, definitely.
And what's the cost of that?
We are bringing it under a lease with an option to purchase. So the cost for us in 2024 is estimated at around $3 million.
Okay, and Jorge, since you touched on that, I know there were also some electricity issues in Burkina Faso where Ghana stopped exporting electricity, and perhaps you could touch on that one and how you're responding there as well.
Yes, and in Yaramoko, our mine in Burkina Faso, we have backup power to run the entire operation. So if there are issues with the grid, we just start burning diesel, right? That, of course, always has an impact on cost, but it does not disturb operations, right? So, we see operations performing normally with, a marginal impact on cost because of the self-generation.
Okay. Adrian, by all means, as you have questions that come up, I want to give you the chance to ask anything that you have on your mind. I have a list here as well, but I'll let you take it if you'd like to.
Just one more question, if I may, on Seguela before we leave Africa, I guess, or before we leave Africa for now. You're running considerably above, the throughput is considerably above nameplates. Are you seeing any potential issues there?
No. I mean, as I said at the beginning, we're really continue testing the boundaries of the design at about 220 tons per hour, which again is 42% above nameplate capacity. We're identifying limitations on pumping, right? Pumping capacity, some minor spillage in tanks and things, but nothing dramatic, no? Or SAG mill is able to take it, or crusher is able to deliver to the SAG. No recoveries are not being impacted. So residence time in the thickeners, residence times in the carbon in leach tanks, or are balanced and able to take the higher load. So, I think from the rate where we are right now, perhaps gains are going to be more marginal if we can achieve them, right? But I think that if we, stay where we are, it's already a tremendous gain. In the original feasibility study, there was a $30 to $40 million budget allocated to achieve this expansion in year 3. And we are achieving this within months of startup. So I think it's a tremendous achievement. And the team has done a really good job there.
Good.
And Jorge, is there a particular rate you would like to see that settle into going forward, or is that still a bit early to tell?
Well, the higher the better. The higher the better. That's as simple as that. But again, every time you build your design and build a processing facility with your engineering firms and whatnot, you build in some wiggle room and in every aspect of the design, because we work with estimates regarding rock hardness and residence time and everything. And it's always an aspiration that you can capture all of those opportunities in the design. And don't not always achieve that, right? You encounter bottlenecks early on here and there. In this case, we have been able to capture all of those opportunities in the design. And so, we see this as a big short-term opportunity for us. As I say, within the portfolio or strongest short-term opportunity is Séguéla running at a higher throughput. And we're, as I said, in a position not just to run above nameplate capacity, but also in a position to run above what we budgeted for 2024, as much as 25% above. So, we look at that with a lot of anticipation. Yeah.
Okay. And Jorge, you've also begun mining at Ancien. Obviously, Antenna was the first pit that you started with. Now that has begun at Ancien. Kula, not that far off. Anything you could share on the progression of the pits that you're going to be mining throughout the rest of the year?
These are higher grade pits than Antenna. Antenna is our anchor deposit and will be our anchor deposit, what will source the bulk of mill feed for some years to come. And then we will be supplementing with ore coming from Ancien and Kula. Ancien and Kula come at higher grades, but haulage distances are longer. No, Antenna is only 800 meters away from the mill. Kula is a few kilometers away from the mill, and Ancien is even a bit further. So we'll have the impact on cost of longer haulage distances and higher strip ratios. No, Kula is about 8 kilometers away from the mill, and Ancien is about 8 kilometers away, and Kula is a couple 3-4 kilometers. So that will have an impact on our cost, but we expect we continue to run at about $1,000 to $1,200 per ounce AISC. No, it's no deviation from what we expect. But the mine is advancing with its plan according to our expectations.
Okay, it's good to see things going on track there. And Jorge, another thing that you have talked about in our previous calls, you mentioned on your investor call the other day, but wanting to create a fortress balance sheet, and love if you could touch on the fact that you had another debt repayment this quarter, also the share buyback program, and I'm sure people would like to hear about that.
That falls all within the concept of capital allocation. We're generating, or business generating, strong free cash flow. What are we doing with the cash? Right? So one is bring down our debt. We believe mining companies should be run with very little debt, and these are the times where you deleverage your balance sheet, right? So we are doing that. We're not a highly debt leveraged company by any means, our debt to EBITDA ratio currently stands at a low 0.2, no? So, but still, we want to see that facility or revolving facility come down. So we paid $40 million in the first quarter, and that comes on 123. That adds to the $123 million we have paid since Séguéla started production. So once Séguéla started production, our large capital requirements were behind us. We started harvesting the cash flows. We started paying on a quarterly basis roughly about $40 million. So right now we have paid over the last 3 quarters $123 million. We have our debt to EBITDA ratio, as I said, at a low 0.2. We also reinitiated or re-engaged with our share buyback program, return to shareholders. We had restrictions to act on that before, but we removed those restrictions, those covenants with our bankers, and reinitiated late in Q1. So we repurchased about 1 million shares, and we will continue to be opportunistic on that. And the other priority is funding the opportunities we have in the portfolio, the organic growth opportunities we have, where we have some clear set of priorities we can discuss.
Do you have a target on where you'd like the debt to come down to?
We will always carry some level of structural debt in our books. I think for a company of our size, anything between $70 and $100 million is inconsequential, really. As I said, our debt to EBITDA is very low, 0.2, right? So, keeping $70 million in the facility, I mean, we can expand the facility and increase our available liquidity, but draw from that, $70 million, $50 million, $80 million, something like that, keeps our banking partners engaged and the facility in place for when we need it. So, something like that. Our expectation is that we'll be net debt positive, no? This year, no?
Yeah. You've done a superb job on the balance sheet. You really have. Did you have a question, Chris?
Yeah, I mean, go ahead if you did.
I was going to switch over to San Jose, unless
that was going to be the next question.
San Jose, obviously you've announced a closure by the end of the year, but you're also being reasonably aggressive with the new discovery you've got in terms of, drilling and time, and you've had some success. So I just wanted to ask you, how are you looking at that? When might you make a decision on expanding, continuing the mine past December? And is it entirely dependent upon the results, or does the political situation in Mexico play into it at all?
Yes. I'll make a note to your comment. You said we are planning for closure by the end of the year, and how I would say is our plan calls for exhaustion of reserves by the end of the year, which is different than a closure decision.
Sure.
Right? So yeah, we have not made a closure decision for San Jose. What we know is that based on reserves today, we are exhausting reserves by year end, right? But we still have an inventory of resources, and we still have an evolving story with the Yesi exploration. So, and as you noted, Adrian, we are drilling aggressively there. 3-4 drill rigs, poking holes. So I see 3 potential scenarios for the San Jose mine. One is we continue mining, no? Because perhaps prices allow us to reassess resources that we have in inventory and move them on to reserves. That could happen. Or we are successful with Yesi and we can incorporate some of that ore into our mill feed and just continue mining. The second option is, by the end of the year, we exhaust reserves, we don't have enough information, and we decide to go into a care and maintenance while we continue exploring Yesi. That's a second option. And the third option is, probably by the second half of the year, we make the decision of closure, right? And then we trigger the closure plan. And that would be because based on our assessment of Yesi exploration and the available resources, we don't see a sustainable operation that fits within our portfolio. So I am not in a position today to make a call on any of those three options. Those are the three options we have in front of us. And we need more time. And I will be in a better position to categorically, I hope, answer that. Hopefully in the third quarter, around mid-year, hopefully in the third quarter, we can say, our path will be one of the three, right? Either closure, care and maintenance, or we can continue mining. We can incorporate some other areas with taking advantage of the higher prices and continue running that mill in a way that makes sense to us, right? So, but I'll say that Yesi has been an exciting discovery, and every time I talk about Yesi, I emphasize this. Many times in this business, you make an exciting discovery, but one thing is an exciting discovery, and another one is an exciting resource reserve that you can plug into a mine plan.
Right.
The discovery needs to graduate to another level, right? So that's how we currently view Yesi. It's an exciting discovery, but we need more information, more time, see if it grows, how it grows. We're excited because we have high grades, it's close to existing infrastructure, easily incorporated, we don't need additional permits. But I'll be in a better position to answer how does the future look for San Jose in a few months. With respect to the political situation, as we know, we have elections in Mexico in June. We have engaged with candidates from both parties, the leading candidate in the polls, which is from the incumbent party, and then the opposition candidate. We have engaged with both, and we believe that for investment climate for mining, under any of the two candidates, things should improve significantly. It is no secret that under this administration, mining has been difficult. This government has had an adverse take on mining investment, mining overall, and so if you ask me, I'm looking forward for these guys to leave office and move on. Yeah.
Can you just touch briefly on the permit, because I know some people will want to know that.
Our permit or renewal or 12-year renewal was taken to court. We went. Our permit, just as a recap, our permit was canceled once again by the environmental office Semarnat in Mexico, really under no grounds of any merit. We complied with everything. And so we took it to court, to the administrative court in Mexico, and the administrative court ruled categorically, once again, in our favor. And we believe the Semarnat has had a hostile attitude and behavior towards us, and difficult to understand. But, we have used the recourse of the law that the law offers to us, and every time we have prevailed in court. So now we got a positive ruling. We are under the protection of the courts, and the Semarnat has appealed that ruling, and we expect that appeal will be resolved by the court probably by the end of the year or early next. But again, this administration leaves in June, July, August, September. Elections are in June, so we would expect a whole different attitude, a more technical approach from authorities, and getting away from the activism that we have seen from Mexican authorities over the last 6 years at least administration has been in power.
And this is the final appeal, is it?
Yes, this is the final appeal. They have no other means of appeal. And again, the ruling in our favor a few months back was categorical. They discarded all of the nonsensical arguments that were put in front of the court. Those were completely discarded.
Good. Good.
And Jorge, one other question while we're still on San Jose. This came in from our dear friend Dave Transler, who couldn't be here with us today as he's in a big tennis tournament. But you touched on this a little bit, although he was asking, are there any additional exploration drilling activity on the mine property outside of Yesi, and perhaps the opportunity to acquire additional claims outside of the current boundaries?
Right now, all of our efforts are pretty much concentrated in Yesi, and in the vicinity of Yesi. Yes. And outside of Mexico today, within Mexico, outside of the state of Oaxaca, we have other exploration programs ongoing. Early stage, we don't advertisement that much because they are early stage. Properties that we believe have early stage properties that have a lot of geologic merit. We have several of those, and again, we don't speak a lot about them because I want to see something emerge before we become more vocal on them. But we have we're exploring in Mexico, and the same, for example, in the Ivory Coast, outside of our Seguela camp. Further to the north, we have a large concession package under an option agreement, and we're currently starting auger drilling, geochemical surface sampling, and the same in Mexico. No, we have other properties in Mexico outside of the state of Oaxaca where we conduct exploration. Yeah.
Okay, and Dave was also wondering on a company-wide level, you reported that you had the 2087 average realized gold price in the first quarter. If we stay over 2,300 for the second quarter, we're looking at $200 higher. Are you expecting the majority of that to just fall straight to the bottom line, or any other calculations that we would want to be aware of and keep in mind?
That's the beauty of this business when prices rise. Huh? You capture all of that, most of that, right? So yeah. No, I mean, I think, and I think we discussed this before. I haven't discussed this with Adrian, but over the past year, I think a lot of us who are active in the mining equities and are market observers have been frustrated with the lag of the GDX and mining equities with respect to the climbing gold price. And I believe the reason has been mainly margins, right? Or margins were crippled over the last decade. So even though prices were rising, our margins were still not very healthy. No, I go back to 2011 when prices, they peaked on a daily basis at $2,000, but let's say
Those were the
a
days.
monthly average of $1,900 on a monthly average, kind of. But what our ASIC was $900, right? In those days, we were mainly a silver producer, and we were producing silver at $9-10 per ounce and selling it at $30 per ounce, right? So that was a business that, of course, attracted a lot of attention, not just from the precious metal specialists, but mainstream. I could have endless days of meetings in the financial capitals of the world talking about Fortuna. That went away, and now prices been climbing, and our margins are starting to expand, and at these levels, starting to become attractive again, I believe, for the generalists, right? The challenge for us, the big task for us who run companies, mining companies, is keeping the lead on cost, right? Not letting cost get away.
Yeah, and you've talked about that before, about how that's one of your top priorities. And you mentioned in our last call that you've seen some of the costs that you're looking at, the inflation subsiding in the past couple of months, has not been rising like we've seen for the past 2, 3 years. Is that still the case? And anything else of note that you've been seeing on the cost side?
Yes, the only place where we have suffered cost increases is Mexico, mainly driven by the appreciation of the local currency, the Mexican peso. And about 50% of our costs are peso denominated, so it does impact. And the near-shoring story for the US, US trying to decouple its supply chain from China and pushing for nearshoring. That means, Mexico is getting a lot of investment. In spite of, I believe that Mexico does not offer today, under this administration, the best investment climate, to be honest. That's my personal opinion. Money is pouring because, the US is trying to decouple from China. It's supply chain, right? So that is, helping the currency and foreign investment into the country. So I would say Mexico is the only place where we have seen cost pressures still, right?
Right. Can I ask another company-wide question? What is the balance? You obviously have base metals from Caylloma. I think Caylloma is the only mine you have base metals. What is your overall company-wide split between gold, silver, and base metals?
Today is 80% gold, 81% gold, 10% silver, and the balance is 6% zinc, 4% copper. I think that's the revenue breakdown right now.
And how do you, is that at Caylloma, is that byproduct accounting? Do you deduct proceeds?
Yes. Now, today, the biggest contributors to revenue at Caylloma are lead and zinc ahead of silver. But in order to do the all-in cost, we do alchemy and turn everything to gold, right?
Okay.
But again, we feel comfortable doing that because at a company wide, it's only 9% of revenue, right? Yeah.
Sure. Well, I think that's a better way of doing it personally.
Because otherwise it makes it convoluted for the analyst and investor to understand the company numbers, no? So I think, AISIC is a non-GAAP figure, and the purpose of that is to help facilitate the understanding of the business to the investor, right?
Sure.
So I think, if base metals were a bigger portion of revenue, I think it would be questionable to convert everything to gold. But today, lead, zinc are combined 9% of consolidated revenue or more.
Okay. And Jorge, I don't think that this had come out by the time we did our last call, but you did have the drill results at Yesi, where you had some favorable intercepts there. And Perhaps you could just walk people through what you came back with and any thoughts on how things are coming along with the drill program.
We continue hitting some spectacular holes as we announced in the latest release, 8 meters at over a kilo. But again, I want to stress that I need to see this grow, because for this to be meaningful in our mine plan, I need tons, right? With this kind of grades, not a lot of tons, but I need tonnage. So, or the focus of our drilling right now is let me tell you a bit about the process. Initially, we drilled to understand it, to understand the geologic controls. Then we started drilling close drilling holes to see the higher grade core area, and now we're stepping up. So this phase is critical, because this is the phase of the program where we will start getting a better sense for size potential. No, I know there is high grade there, but I need tonnage to have an impact on production, right? And that's where we are. And as I said, I need a few more months before I can be a bit more categorical on where is Yesi going, right? So far, we're very hopeful. I mean, I don't get me wrong, but we still need size and tonnage to figure out how this impacts production.
Okay. And one of the final questions I have, something you have talked about quite a bit, is that you want to get to the point where it's not necessarily a matter of getting to 1 million ounces per year, but the quality of ounces, extending the life of mine, having balance within the different projects. And obviously we have Diamba Sud in the horizon and many more targets at Seguela, but anything you could say on the overall efforts of extending the life of mine and balancing that out a bit?
Yes, a very important point. If you look at our journey, Fortuna's journey over the last 18 years, 19 years, we've been growing and growing and growing. And we have grown now to a size where we're a mid-size producer with competitive costs. But I believe that at this stage in our evolution, we need to take a pause from growth and consolidate as a mid-sized producer with assets that can better reflect, a decade plus in reserves. For example, the Cayoma mine, where I'm taking the call from today, it's a mine that's been operating for 500 years, but always with 3-4 years of reserves. Today, the management team has done an exceptional job, and right now we're looking at 6 years of reserves plus resources. I think we can comfortably see this mine operating for a decade. But I want every mine in the portfolio to be able to show a decade plus, because if not, it's a leap of faith on the investors. We're asking the investors to take a leap of faith on our ability to replace reserves, just like our discussion on San Jose today, right? So I want to consolidate Fortuna in the range of 500,000 ounces of gold annual production, with costs at or below industry median, which today hovers around $1,400 per ounce, with every asset exhibiting reserve lives and potential to go beyond a decade. And that is what strategically we've been trying to put together. Lindero speaks to that. Lindero today has 13 years of life of mine. Our acquisition of Roxgold, it was geared towards providing that to us. Seguela, a cornerstone asset in our portfolio today, we easily see a decade plus, right? In terms of reserves and operating at AISC at $1,000, well below industry median for cost. right? But I want 3, 4 mines like that in the portfolio, right? And that's a construction. That's something you build, you construct that, and you construct that making based on the decisions you make every time you do an acquisition or you get involved in an exploration project. You need to keep that vision and that discipline, and that's what we're trying to do, right? I don't see the push in Fortuna to get to 1 million ounces right now. I see the push to get at a solid 500,000 ounce producer with competitive cost, and where investors can look at the reserve lives and see a decade plus. Today, the portfolio is not balanced. I have some higher cost mines, low cost mines, long life of reserves, short life of reserve. So that's the plan. That's the strategy. That's what we're working on, right? And I believe that unlocks value for the investors. And to achieve that, I have a lot of opportunities in the portfolio. Seguela speaks to that. Diamba Sud speaks to that, right?
Yeah. Adrian, did you have any other questions today?
No, not really. Just to, congratulate you. It's been, we did have a sort of hard slog for a couple of years. I think when the sentiment turned against the company, I think in many ways unfairly, the move to Africa, West Africa, has proven to be an exceptionally smart move. But at the time, there was some skepticism. Has Séguéla turned out to be a much better mine than you expected?
Yes. I mean, we always had high expectations, but we're capturing more and more opportunities. And I am at the Cayoma mine with our board of directors. We're touring the mine. I brought the directors to Cayoma, so we're touring the mine with the directors. And today at breakfast, we reflected upon that you just mentioned, Adrian. We said, well, it's been a long 3 years to get some recognition. I always knew that move to West Africa was going to be controversial. I always knew that. But it worked out to be more controversial than I ever expected. And it's taken 3 years. And, I always said the strategy is sound. The fundamentals are sound. We just have to focus on the execution, and they will come.
Yeah.
And, it's been a bit frustrating for us along the way because I think we've been delivering, no? Yeah. Always with some issue and problem that we managed to resolve. But hey, it's mining. It's full of problems every day. So, but we've been able to we have dealt with the emerging challenges, resolved them, moved on and delivered in West Africa on time, on budget, exceeding expectations. The rest of the mines in the portfolio have supported the effort with good delivery. And it's gratifying, I would say, to see today Fortuna year to date. I think if you look at Fortuna's performance, someone said, hey, look at this, right? Look at that cash flow generation, look at the business, look at the strength of the business. And if you look at Fortuna's performance year to date, it outpaces the peer group largely, right? So I still see that as a catch-up. But yeah, I have to admit that it's gratifying because the market is at last seeing, not seeing the value, but wanting to take part of the journey again, right? Joining us again, right? Yeah.
No, it's been great. Thank you very much.
Yeah, and actually, before we wrap up, Adrian, one question, if I may run by you. This is something we often talk about in these calls, but would love to get your perspective. Obviously, you're on the asset management side, and we've been living through a pretty severe bear market in the mining equities. Curious what you've seen, especially as now we have the first quarter earnings coming out, and any thoughts on capital returning to the sector or some of the conversations or sentiment that you hear.
Yeah, the interesting thing is that the sentiment generally among individuals and even small institutions is still not very positive. You know, I talk to all of the people that manage mutual funds, and you know, like us, they're not seeing, you know, consistent large inflows. We're seeing inflows, but you know, 2 out of 5 days we're seeing outflows. You look at a GDX, for example. Now, the last numbers I have are unfortunately from the 20th of April, but every single day in March and up to the 20th of April, there were net outflows from the GDX. So, you know, there is no, and you look at the GLD and other gold ETFs, talking physical now, you know, they're still getting outflows, maybe 3 out of 5 days they're getting outflows. So a majority of the, you know, this year has been net outflows from GDX. So, and we all know that it's the central banks that have been buying gold, it's the Chinese savers that have been buying gold. Plus, obviously, there's some other people in the market, but the institutions are still not there. And the retail is still not there. So to me, as a contrarian, you know, this is just an incredible opportunity when you've got gold approaching 2,400 again, and yet the stocks are acting as though gold was, you know, 1,800 and heading downwards. So I think this is just an incredible opportunity for people to buy, you know, really good quality gold companies, just accumulate them. We don't often get the opportunity, but the stocks are still cheap, even though gold is moving up. And this is one of those opportunities. Do you see it differently, Jorge or Chris?
That seems in line with what I've been seeing, and I think there's a degree to which people have seen the trading in the metals the past couple of years, and especially on the silver side, perhaps even more so when there's a rally, then they're wondering if we're going to be $2 or $3 lower. And I think the past couple of years were tough on people, so there's a little bit of reluctance to get back in. So I would, what I'm seeing matches what you're saying,
Sure.
Jorge.
And I would just say one thing, you know, at the
No,
beginning. No, go on.
no, I just point out that I agree completely, and I think again, I think that attention is going to be drawn back into the sector as we see margin expansion for the miners, and it's taking place, starting to take place, right? You know, again, in the second quarter, we're going to be selling at $200 higher than Q1, no, and if this continues, margin expansion, and as I said, what's important for us is to keep a lid on cost and preserve the margin.
Right.
No.
Right.
Well, we will be there soon enough. And in either case, I would say congratulations on a great first quarter and the things that you've accomplished so far, especially in this past year. We're coming up almost a year now on first gold pour at Seguela. So quite a good year it's been. And I will mention that obviously Jorge, part of Fortuna Silver, which you can find at fortunasilver.com. And also, Adrian Day, I sure appreciate you joining us. And people can find out more about these services he offers with his great body of knowledge at Adrian Day Asset Management. So, gentlemen, thank you both for being here. And certainly good times. Nice to see the gold price up, and appreciate everyone watching at home. Hope you're enjoying the rally today, and be well. And we will see you again soon.
Thank you very much.